Imagine waking up to a 404 error on the website of a prop firm where you just cleared a $200,000 evaluation. Throughout 2024 and 2025, that was a weekly reality. Thousands of traders watched their past evaluations and hard-earned payouts vanish overnight as unregulated pop-up firms collapsed. By 2026, those collapses have permanently split the industry. On one side, you have surviving predatory models. On the other, the rise of transparent, regulated partners. This chart tracks that shift. The red line dropping to zero represents the old retail model, high-leverage gambling disguised as talent scouting. The rising green line tracks the new standard, the Institutional-Lite prop firm. Intermediate traders now face a specific trade-off. You can either chase the lowest upfront challenge fee available or invest in stable, institutional-grade infrastructure. Institutional-Lite firms differentiate themselves by offering verified proof of liquidity and partnering exclusively with regulated brokers and Tier 1 jurisdictions. Choosing a partner based on a discount code rather than their execution mechanics places your entire career infrastructure at risk. Drawdown rules act as the ultimate hidden filter, designed to eliminate traders long before they hit a profit target. Predatory firms rely on equity-based trailing drawdowns to actively hunt your account limits. Consider a $100,000 account with a $5,000 limit. As open equity hits $106,000, the equity-based loss limit trails exactly behind. If the market retraces to $100,900, you're disqualified. Despite a $100,000 balance and profitable trade, the moving floor terminates the account. Institutional-Lite firms use balance-based drawdowns. Here, the loss limit is calculated against closed trades. Open profit is ignored, and the drawdown floor remains anchored. The same market pullback doesn't hit your floor, giving the trade breathing room to reverse and hit the target. When you combine balance-based rules with unlimited evaluation time, the pressure to over-leverage or exit A-plus setups early is removed. These mathematical differences dictate whether a firm is set up to catch you failing or structured to let you trade. Another major trap is selecting a challenge solely because the entry fee is $200 cheaper than the competition. Discount firms often recoup that missing revenue by taxing your trades through heavy spread markups. This chart shows the inverse relationship between upfront costs and execution quality. Red zone firms use cheap tickets to mask execution costs. You lose on every trade. The green zone represents Institutional-Lite firms charging a premium for pure market execution and zero-pip spreads. A 1.8 pip spread difference might seem small, but over 100 lots traded, it drains roughly $1,800 from your equity. That invisible tax makes the cheap challenge far more expensive in the long run. During high-impact news like the NFP, these spreads widen further. Poor execution latency ensures your limit orders are skipped or filled with massive slippage. Prioritizing a cheap entry fee mathematically lowers your win rate and creates a longer, more costly path to funding. Even with good execution, you still have to survive the payout phase, where firms audit your behavior before releasing any funds. Consistency rules are the primary tool firms use to determine if you are a professional trader or a lucky gambler. This tree shows how trading style dictates audits. Traders varying lot sizes wildly or relying on lucky spikes follow the red path to denied payouts. Systematic traders with predictable lot sizes follow the green path, passing the audit and moving toward automatic scaling. Institutional-Lite firms use these positive audits to trigger milestone-based capital increases without requiring a reset. The goal is to move beyond the cycle of payouts and resets, transitioning your base level account into a multi-million-dollar allocation backed by real hedge funds. While consistency rules disqualify gamblers, they also create an auditable track record that allows professional traders to safely scale. Now we have officially moved past the chaotic era of pop-up firms and into a stable, professional ecosystem. Success in 2026 requires evaluating prop firms as serious infrastructure partners rather than temporary casinos. Use this 4-point audit to vet any firm. First, they must provide proof of liquidity or a regulated broker partnership. Second, they need balance-based drawdowns. Third, they must guarantee zero spread execution. And fourth, a clear milestone-based scaling plan. Traders reliant on revenge trading and extreme leverage will find the Institutional-Lite model restrictive. This infrastructure is built for systematic traders who prioritize capital preservation and long-term career growth. Audit your current firm against these benchmarks today. Ensure you are building a resilient career rather than paying for a temporary illusion.